session, which is great. So I will hand over to you.
Beautiful.
Alex Ong from Traders Corner, over to you. Thank you.
Thank you. Well, good evening, everybody, and welcome to my webinar, and obviously welcome to the Round the Clock Trader. In this webinar, we're going to be talking about 3 chart patterns and basically how to be effective without overcomplicating your trading. Before we go into that, because we will be looking at some live charts and things like that, I just need to say the content of this webinar is not investment advice. Okay, and should be used purely for educational purposes only. All participants are advised to seek their own counsel prior to investing or entering into any trade. Spread betting and any other type of financial trading carries a high level of risk to your capital, with the possibility of losing considerably more than your initial investment, and the content of this webinar may not be suitable for all investors, and an individual should ensure that they're fully aware of the risks involved, and if necessary should seek the advice of an independent financial advisor. So now that we have that out of the way, because no doubt there will be questions later on to do with some of the current live charts, perhaps some talk about Brexit and the potential impacts, so we've got all of that out of the way there. To introduce myself to those of you that have never met me before, I've been trading for over a decade now, so since about 2005. I'm the co-founder of a website called Traders Corner. My brother and I have been teaching people for a number of years now. We presented at various financial exhibitions around the world, and here it says the Twitter. If you want to follow us on Twitter, then we give a Facebook link, so that's a typo there. But if you want to follow us on Facebook, that is a link there. So that's facebook.com/Traders Corner online. So that's enough about me. You guys don't care about that. You want some good stuff that you can use in the markets as soon as tomorrow. As Simon said earlier on, if you have a question, please sort of try and keep them to the end. And then I've left enough time to be able to go through all of your questions, and that will just allow me to get through the presentation and give you all of the good stuff, and then come back and answer any queries that you may have. So, in a world where there are literally thousands of ways to find opportunities in the markets, it seems, and you guys know that I'm right when I say this, that the retail arena believe that more complicated is more effective. But the truth is, in fact, exactly the opposite. But why? Why is it the opposite? Well, complexity kills. And the reason is that new traders, okay, they need something that's easy to learn, okay, that's easy to back test, and really, most importantly, is easy to utilize when you're under pressure, when you're at the hard right edge of the screen and you're trying to put on your trades, and maybe you've had a couple of losing trades. You need something that's not very complicated. You need it simple, easy, and repeatable. And new traders, they go into this cycle of trying to find the best trading system, and they just don't accept losses. So every time you have a loss, you look at finding a way to filter out that loss, and you add an indicator and another indicator and another indicator until you get to a point where ultimately you can't find a trade setup, because your filter, you've got so many filters going on, you don't know what you're doing. Okay, now the key to successful trading is that you need to keep things simple. Yes, I don't have a problem with people having indicators on their charts. If it helps give you confirmation and you're not using it as sort of like the primary and the foundations of your trading approach, then it's absolutely fine. Okay, the problem that I have is that when indicators become the be-all and end-all of your system, and we'll talk about that in this webinar right here. Now, the financial markets, they can either trend consolidate or reverse. All right, it's really as simple as that. If you can work out which one the market is doing, then you're already way ahead of the game. If you can put context around your trading and not just, take every single trade setup blindly, then you're going to be able to put yourself in a position where you can succeed. If you don't want to do that, then yes, you will have periods of successful trading, but inevitably there will be times when the market condition changes, and the trading strategy that you trade won't be suited to that particular market condition, and then you'll start to lose money. And you'll do what every single retail trader, struggling trader does. You will say that this system doesn't work. You'll throw it in the bin, you look for another system that's working on the current market condition, and all the while you won't be taking note of the fact that actually, it is just because the market has changed slightly, is the reason that your system isn't working. If you kind of just were to put context around your trades, then you'd be in a much better position to be consistent regardless of the market condition. And that's what we're going to show you here. You see, trading is, for me anyway, is as much an art as it is a science. All right? There's a famous quote by a gentleman by the name of Sun Tzu. Some of you may have heard of him. He says, "He will win who knows when to fight and when not to fight." You see, successful trading, as I just mentioned, is as much about reading the market conditions, understanding the context of the trade setup that you're about to take, as it is about your trading strategy. You could have the best trading strategy in the world, but if you don't understand when to deploy that strategy, you're going to lose money. Now, my brother and I we haven't traded for any big banks or anything like that before, but we have been fortunate enough to go to school with a number of traders. And we've got a particular friend who was trading for a bank back sort of like 8-9 years ago now. He's since actually left the profession altogether, and he's a TV producer, but I digress. When he was working at the bank, he was a quote-unquote trader. But you know what his job was? His job in the bank was to decide when to deploy their automated trading strategies, okay, and when to switch them off. To basically analyze the market condition and decide when it was right for their trading approach and when it wasn't. So if the big banks are doing that, if the big banks don't have a robot that they just leave to run all of the time, then why would you think that it would be any different for you? Okay, so this is one of the key things I really want to get across to you in this webinar of it that we're in right now. Is I want to get across that the market, it's as much an art as it is a science. Yes, you can put mechanical rules around things. Absolutely, you can do it. But if you want the consistency, if you want the longevity, you have to be willing to engage your brain just a little bit. Okay? Now, the market has an energy. And we as traders, we have to learn to read this energy. Unfortunately, it's not something that can just be taught. It's something that you will have to learn with screen time, all right, to sort of understand how the price approaches a particular level, how it potentially is going to react. Okay, you need to understand how the market is moving. It's not good enough just to say, well, the market is moving up, I'm going to be buying. You need to look at the energy behind the market. So how is it moving up? Are the swing highs that we're looking at now, are they not as big as the previous one? So maybe the previous time the market broke the highs, it went on to really significant highs and it went a long, long way. But now when the market breaks a high, it's barely sort of staying above that high, then it's coming back below it. All of these types of things are clues that will help you decide when a trade is right to take or when it's not right to take. Is the price just grinding in a direction? Okay, and hence actually, is it difficult to find the dominant party, or does the market look like it's reversing altogether? All of these things as traders, if you want to be successful, these are things that you have to learn to read. Okay, now the trading principles for a technical trader. Right, and I'm not saying that this is, for fundamental traders, but for technical traders, and this is what we're talking about here. These are things that you must learn to sort of live by and accept. When all variables have been taken into account, okay, the end result is the price. It's what you see in front of you. All of the indicators in the world, okay, are based on the price action. So yes, you can put indicators in there to give you confirmation, but it's the price action that's really going to tell you what's going on. You see, traders will behave in the same way to price developments as they did before. It's our human nature to experience the same emotions when losing or when winning or losing money in the markets again and again and again. And it's this predictable nature of our reactions in the markets that lead to trading opportunities. Okay? That's how we find good high probability trading setups. So as a trader, it's your job to identify your low risk entry points. Okay, that's the only variable we really truly have control over. We have to quantify our risk and accept it. We have to only trade the high probability setups. That means that regardless of what your strategy is, you can only trade when everything is aligned. So when the market condition says that you're trading, that this is the right condition for your trading strategy. And if possible, have a positive risk reward. You know, we were saying when we met with Simon earlier on in the week, we just so happened to have been looking over our trading, our FX trades for the first part of this year, so for the first 6 months. And would you believe it, our strike rate has been abysmal. It has been absolutely shocking. We didn't actually know this until we went over the charts, because we don't babysit our account every single day. We just trade the setups when they present themselves, and we come out ahead of the game more often than not. But our strike rate this year, like I said, it's been abysmal. 44%, I think the number is the number of trades, percentage of trades that we have got right this year in the Forex markets. It's been a tough market. 44%. But we are up over 30% on the year, taking very, very modest risks to get to that number, because we have a positive risk reward. You see, so if you have a positive risk reward, then you remove the necessity for you to be sharp with your trading every single day. You don't have to be on point, because you're not relying on a super high win rate to make you profitable. Okay? Now, once you have a trading strategy, once you understand the rules, you need to learn to apply them systematically, to do the same thing again and again and again when the trade setup presents itself in the right market condition. And finally, you need to make sure that you don't marry a trade. Okay, because if you marry a particular trade idea, then you're going to hold it for longer than you need, and that's going to cause you to lose a significant amount of money. So how do we trade? Well, we use charts for context. Okay, we use financial charts to help us put context around our trades and to help us identify entry and exit points. The chart can tell you a story, which can lead to you finding trading opportunities. Okay, charts help us to identify areas where we can obtain an edge. It's a visual representation of what's happened in the markets. I said a few slides ago that human beings tend to display the same sort of reactions time and time and time again. So charts are a visual representation of that. They help us to identify when this is occurring and help us to identify good, high probability trading opportunities. Human beings, they have a tendency to take a similar action when presented with similar situations. And it's this trait that we as traders, we must learn to exploit. This is the primary reason that a chart can be so helpful. It allows us to identify situations where the crowd may act the same as they have before. Okay? So the first two patterns that you must learn to read are those of a trending market and those of a range-bound market. Now, when you heard three simple chart patterns, you probably thought, oh, these are all about entries and exits. But the three simple chart patterns are about so much more. This is what's going to make you profitable if you can identify this. If you can identify what is a ranging market, or what is a trending market, and what's a ranging market. So you know when you want to be buying support and selling resistance, or when you want to be buying resistance, buying through the breakouts. But only by understanding the market condition are you going to be able to do this. So what is a trend? Well, from a technical perspective, a trend is a series of peaks and valleys in the markets that's moving in one direction. An uptrend is a series of higher highs and higher lows. A downtrend is a series of lower highs and lower lows. And knowing the market condition is of paramount importance to profitable trading. In a trend, we want to be trading in the overall direction of the trend. In a range-bound market, as I said, you want to be buying bottoms and selling tops. The market has a structure to it. I don't know if anybody's heard of this before, but it allows us to identify the trends in the markets. Knowing the direction of a trend allows us to take high probability trading setups. Now, one way that you can use to identify a trend, and it's a technique that we use, okay, is we throw a moving average on the chart. Now, we don't trade just based on this moving average, but it helps us to understand what the trend is at a glance because it gives us a reference point. Where is price in comparison to the moving average or in relation to the moving average? And the one that we use is a 100 moving average. Okay? The simple rule is that if price is above the moving average and above the previous highs, then it's bullish. You want to be looking for buying opportunities. If it's below, then you're bearish and you want to be looking for selling opportunities. Okay? One of the questions that I get asked a lot by new traders is, okay, so I know what a trend is, higher highs and higher lows, easy peasy. But in an uptrend, what is it that actually technically holds the trend in place? So, for example, if the market fails to break out to a higher high, are we automatically in a downtrend? Or, in a downtrend, if the market fails to break out to a lower low, are we automatically in an uptrend? No. You see, in an uptrend, it's the higher lows or the structure lows that hold the trend in place. In a downtrend, it's the lower highs or the structure highs, you can refer to them as both, that hold the trend in place. Because if you think about it, a trend is a series, an uptrend is a series of higher highs and higher lows. A downtrend is a series of lower highs and lower lows. So if we were in an uptrend, okay, and the higher low was not broken, we could not technically say that we're in a downtrend, could we? Because we don't have the series there. Does that make sense? And I'll show you what I mean by this when we look at the charts in just a few minutes. But I thought it would be an idea just to put that out there because I know that this is a question that we get asked a hell of a lot and potentially you will be asking the same question. But once you are able to identify and define a trending or a range-bound market, and you can start to see the structures in the markets, you can then use key levels and support and resistance to build a trading system. That's all you need. So, how do you actually know then that you're in a range-bound market? We've defined technically what a trend is. What's a range-bound market? Well, a range-bound market will seem more chaotic. There's no real harmony in the price action. You don't have higher highs and higher lows or lower highs and lower lows. You'll see a lot of failed breakouts. And you'll not really be able to determine which direction the market's actually going in. So let's jump over to the charts. Okay? We've given it enough theory for just a moment. Let's jump over to the charts and actually take a look at this price action. Take a look at what I'm talking about. Look at these patterns so that you understand what it is. And once you understand these two chart patterns, so what a range-bound market is and what a trending market is, then we can go on and we can start to talk about the last pattern on a chart and how you want to trade it, which will be your entry. Sound like a plan to everybody? I hope so. So, I've got TradingView in front of me. Hopefully you can all still see my screen. This is actually just a random chart here. We can change it to any one you want, but let's actually start with this one here because it's actually almost picture perfect. So this here, you would have to say that the New Zealand Canadian dollar is in an uptrend, right? If we look at the moving average, price is above the moving average. But more importantly, look at the swings in the market. Look at how harmonic this price action is. We don't have big reversals. Put a trend line in there, tracks a trend line beautifully. Every time the market breaks out to a high and then pulls back. It's actually finding support, and I love these sorts of what's the word for it? This behavior. Pulls back and it finds support on a previous level of resistance. But it's consistently printing higher highs and higher lows. You could actually make a trading system just based on this. Waiting for the market to break out from a level, then pull back to a level and trade from there. Like so. So can you guys see this here? Clearly, we're in an uptrend. You look at the screen, starts in the bottom left, ends up in the top right-hand corner of the screen. This sort of market here, you would be looking for buying opportunities. You'd be looking for those buying opportunities around support or resistance levels. You can't make this up. How easy is this trade? The market breaks out from there with some momentum. The next time it pulls back to what? Previous level of resistance becomes support. We'll talk about the actual entry criteria in a little bit, but I can tell you that this is a good opportunity. You'd go long there, stop below the lows. You'd have more than 1-to-1 before you even get to the high. The market breaks out from that level. Where does it pull back to? Previous level of resistance is starting to act as support. The market bounces from it twice. The market breaks through a level, it comes back to it again. If you could wait to identify charts, okay, that look like this, that are harmonic like this, you will make yourself a lot of money. This price action is beautiful, absolutely perfect. That is a trending market. That is nearly impossible to lose money there if you understand the market condition. You know, a new trader, for example, let's say they said that they aren't trending a trending system. Let's say they're trading a ranging market system. They would get killed every single time. The only justified place that they would sell would be here. You could justify a sell there, stopped out. All right, the market pulls back. They wouldn't be looking to buy from here, but they should be. They should be looking to buy from there. Maybe they would sell here on this high, not waiting for any sort of a confirmation or anything like that, not knowing that actually we just broke out of that previous high there, so you need to be extra cautious at this level. They just trade their system blindly, not looking at the market context, not looking at the market condition. This truly is, for a technical trader, what I'm showing you right now. These are the keys to your continued success in the financial markets, whether that be currencies, whether that be commodities, stocks, whatever it is. Okay, so that's a trending market. Let's go take a look at some other charts, just so you start to get a bit of a clue. Okay, so this market has since broken out, but up until that point, around here, this I would consider a range-bound market, because the market doesn't really know which way it's going. Right? You can see that the price action, after this momentum move to the downside, the price action starts to get, let's say, a little bit ugly. So it gives an opportunity to go short, breaks back up above the highs. Breaks down beneath the lows, doesn't hold beneath the lows, breaks up above. Goes to break the lows again, can't break it, comes out above. Okay, then breaks the highs, doesn't spend any time above the highs, comes back below. Breaks the highs again, doesn't spend any time above there, comes back below. That there, for me, is an ugly market. There's no real direction there. Okay? What about pound dollar? Pound dollar has been ranging up until today since the beginning of the year. And before that, you can't really even call that pretty price action. You'd have to say that actually we've been in a range-bound market in the pound dollar since the beginning of 2015. The market's been going sideways. Yes, it broke to the downside, but this is not harmonic price action. No one can, in good conscience, tell me that what the market is doing here is trending. So in these sorts of markets, you would want to be selling the highs and buying the lows, buying support, selling resistance. They would be the types of trades that would yield you the biggest return on your investment, the highest probability setups. Look at the pound yen. What do you reckon that is? Be honest now. We're going into a bit of an ugly phase there, but ultimately this market has been moving down, and only just, in fact it's not even done that just, it's still not broken the previous swing high. So even though the market hasn't gone to any great lengths, this is still kind of holding it in place here. Okay? The market is moving. You can see that there's a direction there. If this market then breaks back up above here, you'd have to say that we've moved into a range-bound market, absolutely. But currently, this is sort of like, this is its last chance. Let's pick another random chart and see if we can identify it. This here, New Zealand franc. Ignore today. Obviously, we've got the Brexit stuff going on today. But look at this chart here. Absolutely atrocious. It's moving sideways. So what's the best strategy to employ here? Buy highs, sell lows. Let's move that back up there a bit, sorry. That's what you'd be looking to do. So when the market comes down to the lows, you'd be looking for an opportunity to buy from there. When it comes up to the high, you'd be looking for an opportunity to sell. Okay? So the two key patterns that you need to understand first of all. One, what is a range-bound market? The other, what's a trending market? Hopefully you can see that. Let's go for a few other charts. Dollar CAD.
Alex?
Yes, sir.
Trevor's asking, on the New Zealand dollar, Canadian dollar chart, he says, what do you look at on the higher time frame before taking the long trade on the 4-hour chart?
What do I look at? In what respect, sorry?
So what do you look at on the higher time frame on the New Zealand Canadian dollar before taking the long trade on the 4-hour chart?
So you would look to see that ultimately you're not trading into any super significant levels. So for example, if a trade presented itself here, for example, I wouldn't take that trade, even if it was showing a beautiful trend on the lower time frame. But on the higher time frame here, from the point that the market breaks out above this level there, okay, from a daily perspective, we now have some movement to the upside. So you could consider taking long opportunities on the New Zealand CAD. But the main thing that you look at is that you're not trading into any significant level. And if you can, you want to be trading in the same direction as the momentum of that particular market. Does that make sense?
Trevor, if you're listening to yes, great. Harminder's saying yes.
Yeah.
Thank
Cool.
you. Thank you. Yes, yes, says Trevor. Great. Okay, so we've got that. Thank you.
Okay. All right, let's jump back over to the slides very quickly because I can see that time flies when you're having fun and we're already half an hour in. So once you determine what type of market you're in, okay, and you can decide which strategy is going to work best for you. Typo there. Buying the pullbacks or selling the highs and lows of a range. Okay, the chart pattern that you will employ is exactly the same in both. Okay, now the theory of this is very different to the reality. So I could sit here and give you a bunch of other charts, of other slides to show you the pattern, the perfect pattern. But we all know that the real markets, they don't work like that. So let's jump across to the charts, jump back across to the charts, okay, and talk about how you can look to enter your trades once you've identified the opportunities. All right, and let's use, since we're on the New Zealand CAD, let's use that as an example. All right, so we identified this high here. Once the market broke through that high, we're then looking for opportunities to buy the market. So the first thing that I would do, okay, is identify where potentially would the market turn around. And we've got a great spot here with this previous high there, that previous high there. So if the market's going to turn around, it's going to turn around somewhere at that level. Now to get into the markets, what I do is I jump down to a lower time frame. So this one here is presenting itself on a 4-hour time frame. So I would jump down to something like the 1-hour time frame and look for the chart pattern from there. And what you're looking for, okay, is you're looking for the market to reject a level. And this can be done in a number of ways. But my favorite way to get into the market is to see the market clearly break a level. Okay, clearly breach a level. And it's not going to happen every time, but clearly breach a level and then start trading in the opposite direction. Because what should happen at these levels here, right? Let's take, so this opportunity here, to be completely frank, I wouldn't have got long here, so I wouldn't have been able to benefit from that move because there isn't really the breach of the level. All right, but here we can see that the market breaks below the level. And what you would be expecting at that level there, once it's broken, is you've got a number of stop orders below that level. You would then have people, if the market truly was meant to be going down, you'd have the big players. That would be an opportune moment for them to get into the markets. Okay? But instead, what you see is sort of like a liquidity drive here. So you see the market break the level, but all of the orders beneath this level here, all of these stop orders are mopped up beneath that level. And that is the biggest clue that you can get for the direction of a trade. If, when you break a level, the market doesn't want to go any lower and instead turns around and closes back above. So on this candle here, when the market closes back above this level, that would be your first opportunity to get in. If you want a bit of extra confirmation, you can wait until these highs here are broken. Okay? Once the market closes back above that level, that's an indication for you that it needs to go higher because it had an opportunity to go lower. If the bigger players in the market were going to take this lower, they would do it at this level here. Okay, that's their opportunity. That's where they can sell. Okay, that's where a bunch of stop orders will be. So you should get momentum at that level, but because you don't get momentum, that tells you that there's a greater force beneath that level, consuming all of those orders. Okay? So it shows you that the big money actually doesn't want that to go any lower. And because you know what the market condition is, because you know what a trend looks like, that makes sense to you. That whole scenario there of the market going long, that makes sense to you because that's the way that you wanted it to go anyway, right? Because you believe that the market is trending. And in a trending market, the high probability trade is to trade in the direction of the trend. Correct? And then we can move along. So the next opportunity, where else would you look to get in? Put your support and resistance level at the next high. Okay. You wait for the market to break beneath the level, which it does. You wait for it to close back above, which it does here. Just about there. But certainly here. If you want extra confirmation, you can wait for it to break above a level, which would be this one here, if I move that in for you. You can wait to get in there. Stop beneath the lows. Market goes on and pays you. So you see, the pattern for getting into a trade is to see the market breach a level, to see the market break a level and reject the level. That's my favorite kind of trade because it's so obvious. You've given the market there. Look at that opportunity there. We've given the market the opportunity to go short. It's broken the level. Okay? It's broken beneath this previous level here where there was clearly some buyers in the market. It managed to get beneath that level, but it held at that level. And then you go long. Because it's been rejected, because it had the opportunity to go short, and all you had was a whole bunch of buyers beneath this level here. Now, will it work every time? No. You'll have losing trades. Like I said, our actual strike rate this year has been appalling. But trading like this allows you to get in with a decent risk reward. And actually, when the markets generally are behaving themselves, our strike rate is more around the 60 to 70% trading this. Does that make sense to everybody?
Alex, are you looking at mainly trading off 4-hour charts? Asks Andy.
In the Forex markets, I do like a 4-hour chart, and I'll tell you why. In the Forex markets, obviously you have fundamentals that drive the markets, but you also have like these mini themes that drive the markets as well, right? So you have the longer term fundamentals like the interest rate differentials, the central bank policies, and things like that, that are ultimately going to drive the direction of a currency. But in between time, you get things like the focus on Brexit or Greece, for example, or a natural disaster hits. And those themes play out more on a 4-hour chart. You can see that more on a 4-hour chart than you can a 1-hour chart. You'll see some big candles on the daily chart, sorry. You'll see some big candles on the daily charts, but you won't necessarily find the opportunities to get in, to enter. So from an FX perspective, I quite like the 4-hour chart because it allows you to trade the themes.
And Trevor's asking about tradingview.com, the platform you're using at the moment. What is the source of the price data feed?
So for the currency markets, is FXCM is one of the sources. If you want other like stock data and things like that, then you can subscribe to the exchange feeds.
Now,
but this data here is FXCM.
FXCM, okay. Hindsight is 2020, says Tony. Can you determine support and resistance in real time?
Of course. Absolutely. Hindsight is 2020, but there's nothing about hindsight here. This is a resistance level right there. Looking at that chart, okay, everybody on the call, tell me if you can see that this is a resistance level. Yes or no? This one here. Are we getting yeses?
We're getting yes, 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 yes.
Okay.
Great.
So we've agreed there. Wonderful. So when the market breaks out above that level, my favorite concept is that of previous support becomes resistance or previous resistance becomes support. So we've already identified that. Everybody on this call identified that as being a resistance point. So when the market breaks out above that level, the next time it comes to that level, that's where you're looking for the reaction. Does that make sense?
Mm-hmm.
So you can't really project where it will be. I mean, you can with trend lines. You can say, well, I believe that a support level will come up here. You can do that. That's effective. But just a horizontal line, if you put that at a support or a resistance level, the next time the market approaches that level, it will react to it in some way.
Okay. Does it, Alori says, does it need to be 2 hits, though, to be called a proper resistance level?
No. No, absolutely not. It just needs to be a reaction. So a resistance level, you need to see the market go to a particular level and then clearly reject that level. You don't want to see the market move up to a level, move sideways, then carry on moving up. That's not really a resistance level. So it's to do with the way the energy. So earlier on, I talked about the energy of the markets, okay, and the way that the market approaches the level, the way that it reacts to something. So it doesn't need to be 2 touches. It just needs to be a reaction. As long as there was a reaction there, you can tell that there was a battle between the bullish parties and the bearish parties, and one side won. And therefore, there's a memory in the market. So the next time the market comes to that level, there will be some sort of a reaction. But remember that we don't just trade it blindly. So we're not just going to trade it because it's come to a level. The first thing we do is we identify whether it's a trending or ranging market. That will determine what type of a trade do we want to take at that level. And then we look at the price pattern of the price breaking through a level, clearly breaking through a level and rejecting the level. And then you get involved in the trade. Are there any other questions?
Okay. Do you ever use volume profile charts to determine support and resistance?
Not on the currency markets, because there is no real true representation there. But I like volume at price, and I do use that. I don't use it as much now, because support and resistance, you tend to be able to see them anyway on the charts. But I don't mind volume at price, using it on things like the DAX and some of the futures markets where you can actually, it means something. But in the FX markets, it doesn't really mean anything.
Okay, thanks. Says Andy, that's great. Okay, any other questions at the moment?
I thought there'd be loads more.
Well, thanks, Alex. Says Laurie. Also, earlier you drew the trend line on the New Zealand Canadian dollar, which cut through a couple of candles, but touched a few wick ends to make it a proper trend line. Is it okay to judge it like that, or use ends?
Okay, yeah. So that's
You need me to repeat
a
that?
very, very good question.
You got it.
Pardon?
Do you need to repeat again, or you got that?
No, I've got that. I've got that. So that's a very, very valid question. And the thing that I would say to you is that basically you're not looking for pip perfect touches and things like that. All you're looking to do is you're looking to roughly, identify where you're going to see a reaction in the markets. You're looking to encapsulate the majority of the price action, if you like. So looking at this here, I don't have a problem with that going through those candles like that there, because that's kind of getting the majority of the price for me. You remember, you don't trade these levels in isolations. If you can kind of get the area within 5, 10, 15 pips, then you look for the reaction at that area. Does that make sense? There's no centralized exchange in the currency markets, but more importantly, it's this idea of there being perfection that stops a lot of retail traders from making money. You guys and girls, you don't have to be perfect. In fact, the moment that you accept that there is no sort of perfect ABC reversal pattern or something like that, and you just accept that you can identify areas on the charts, and once you identify the market condition, you can look to see how the market reacts to that level, and that's good enough. That will make you money. You'll start to make a lot of money then saying, oh, this has to be an absolutely perfect trend line. Because, to be honest with you, because there's no central exchange, a trend line from one provider may look a little bit different to one from another provider.
What about
provider? I mean, sorry.
What about Fibonacci's 50%? Says Rob.
I do like Fibonacci's. I don't typically draw them on my charts just because I sort of know where the levels are. I used to use them quite a lot, but you'll tend to see that the Fibonacci levels, they kind of coincide with where your support and resistance levels would have been anyway. So we had a level in here, which is the 50% level, which was roughly where we had that resistance level in to start with. right? If we go up to, let's get rid of this trend line. So if we go up to, which was that, this price move here, markets reacted with that 50% level, which is more or less where we had our resistance level anyway, which then became support. So I do look at Fibonacci, but more subconsciously than actually bringing it out on my charts nowadays. And I wouldn't trade it in isolation. There would need to be another level there. I wouldn't trade it just because price has approached, the 50% Fibonacci level. There needs to be another support or resistance level there.
Stochastics. Do you use indicators such as stochastics? Asks Harminder.
I have done. Currently, no. But I have done in the past, and there's no problem. You can use them if you want to use them for divergence or something like that. That's absolutely fine. But personally, no. Not when I'm just trading price action. But as I said at the beginning, you get more and more confident with your approach and yourself and your ability. In the beginning, sometimes you need indicators, and that's absolutely fine. If it gives you that little bit of extra confirmation, if it makes you feel better about taking a trade. But once you're experienced and you understand that you don't need to be perfect, you just need to be good enough, and you will make money. And you'll be surprised at how your trading fortunes turn around.
Ray says, "Would I need an appointment to come and visit you, Alex? Do you do you have an open door policy, or how do people get in touch with you? What's the format?"
Well, yeah, I mean, we're happy for people to come in and meet with us. That's not an issue at all. Obviously, we need a little bit of notice. But yeah, I mean, if you drop us an email to start with, then we can always go from there and see what works best. And our email address is support@traderscorner.co.uk. So I'll put it in.
That's all right, I'll put it in just now.
Yeah.
Traderscorner.co.uk.
Okay.
There we go.
But yeah, I mean, feel free to drop us an email.
You're in Central
and we will do whatever we can to help. Yes.
Yeah.
Yes, indeed.
Great. So he might get in touch with you. Laurie has come back and says, "Great, thanks, Alex." He was asking about drawing the trend lines. He's got to use that idea from now on. Previously, he's been using end of spikes, so he's happy about that. And Trevor says, "On a higher time frame, what is the best way to determine a trend for deciding when to enter a trade on the lower time frame?"
So it doesn't change. The time frames that you use, the chart pattern, it doesn't change. It's exactly the same thing. If it's just dependent on when you can look at the charts. Do you know what I mean? So the higher highs and higher lows, it's the same on a daily as it would be on a weekly, as it would be on a 4-hour. There's no difference there. Was that the question, or was he maybe asking something else?
I've got on a higher time frame, what is the best way to determine a trend for deciding when to enter a trade on the lower time frame?
Yeah, I think I answered that.
Yeah.
Let us know if that wasn't what you were asking, sir, but I believe that I answered it. Ultimately, it would be exactly the same. There's no difference.
Perhaps you could encompass some of these principles on a low-cost course rather than the high-end pricing, which many cannot afford. Videos are really helpful, asks Laurie. Probably Laurie can visit the website. There's all sorts of different things.
Yeah, I mean, if you go to our YouTube channel, there's a bunch of free videos on this, on technical analysis, which costs nothing at all. So start there and let us know if that's helpful to you.
Some suggest you look for confluence on different time frames, says Dina. She thinks that's what a previous questioner is asking about, the confluence on different time frames.
Yeah, I mean, you can do. Obviously, you don't want to be, as I said earlier on in an answer to a different question, what you don't want to be doing is trading into a huge level. Okay, so with this chart that we have in front of us, what I wouldn't want to do would be taking a trade up here. So if an opportunity is set up and it was going into that level there on the daily time frame, so how far are we away from that on the 4-hour time frame? So if we had an opportunity here to go into this level, I wouldn't trade that. I'd wait for the market to get out above that level and prove that it wants to hold above that level for me to take the trade. So that's from a higher time frame perspective. Obviously, you look to identify the market condition. That's the first thing. But then the second thing is to look at the context. Where are you trading from? Don't trade into any big levels because it will just cost you money.
Again, Paul's on the time frame. He says, which time frame do you base your analysis on? And on which one do you execute the trade?
So again, this is, and I like that question, to be honest with you, but it's, how do I put this? A lot of new or struggling traders ask this sort of a question, but the answer is that I'll take a trade off of any time frame that's showing me an opportunity. I don't have a set of rules that say you can only trade off of, you can only say execute based off of the 1-hour chart. You know, if I see a massive trend, for example, on a weekly chart and there's an entry on the daily chart, I would do that. By the same token, if I saw a big trend on a 1-hour chart and I was looking at the 5-minute time frame or something like that, I'd be just as happy to take that trade. So the other thing I'd like everybody here to take away with them, as I said, is that you don't need to be perfect. You just need to be good enough. And that also kind of goes for when you're choosing the time frames. Don't limit yourself. Don't say I only trade the 4-hour time frame, because then what happens when you just happen to be looking at a chart and you look at the 1-hour time frame and you see an opportunity there? Will you not take it? Even if everything is saying that that's the right trade, of course you'll take it if you want to make money. You know, you need to kind of, as I said, trading is, for me, it's very much an art. You know, it's just as much of an art as other people will say that it's the science. It's a combination of them. But don't pigeonhole yourself in saying that I'm one specific type of trader, because when the market condition changes, then you aren't that trader anymore, then you're losing money. The best trading approach and trading system, as I said, from a technical perspective, is exactly what I've shown you here. Look for price action. Find out whether you're in a trending market or a range-bound market. Identify the support and resistance levels where you're expecting a reaction to be. And if you see a reaction at that level, take the trade. Whether that be on the daily time frame, the 4-hour time frame, 1-hour time frame, weekly time frame, 30-second time frame, whatever it is that you want to trade.
Dina says, your method looks for support and resistance close by, which negates the need to look at the next time frame. I prefer your simplification! Exclamation mark. That's good. I like your style,
Cool.
says Nancy. It always looks so
Thank
easy
you very
in
much,
hindsight.
Nancy.
It always looks easy in hindsight, says Dean, of course. Tony.
It does, but can I just answer? Can I just
Yeah.
approach that for a second? It does look easy in hindsight, and when you've been trading long enough, and this is another thing that I said about there are certain things you can only get with experience, then your actual trading will start to look like your hindsight trading. And what I would recommend that you do is do a great deal of hindsight trading. Go back over all of the charts that you can get your hands on and prove to yourself that this type of trading works. Okay, and then practice by putting, putting a card over the screen or whatever, so that you can't see what the price action is going to be, and go forward 1 bar at a time. It does look easy in hindsight trading. I absolutely agree with you. But as I said a number of times on this webinar here, once you accept that it doesn't have to be perfect and it just needs to be good enough, you'll find that you're getting into way more of these trades than you previously were, because you're not looking for that perfect setup. But then when that perfect setup doesn't present itself, you don't take the trade, only to look back on it and think, oh, well, I could have got in here or I could have got in there. Because if you look at this trade here on the New Zealand CAD, that's by no means perfect, is it? look at this. It's a little bit untidy around the edges there. You don't have a perfect 1, 2, 3 reversal or candlestick pattern or anything like that, but it's good enough. Why? Because the pattern that we're looking for is just the pattern of the price, is the price rejecting a level, and that's good enough for us. If you would say I'm looking for a 1, 2, 3 reversal pattern, well, you don't get that there. You don't have a 1, 2, 3. There is no pattern like that there. So in terms of hindsight trading, this would be like a primary candidate where you would look back on this and think, oh, that's such a great trade with the benefit of hindsight, but I never would have been able to get in on it. But if you accept that you don't have to be perfect, then they're the types of trades that you'll find that you are getting in on. And then your hindsight trading will become your real trading.
Javier says, thank you, Alex. Always enjoy your webinar lessons and video analysis. Wow, I look forward to the recording of this, says Nancy. Thank you, says Wayne. Yes, fantastic. It's all been a big help. Thanks, Alex, says Laurie. Great stuff.
Thank you, people.
Excellent, says Steve. Fantastic. Well, thank you very much. That's a full hour that we've kept you going for, Alex, which is great. Paul.
No problem. I enjoyed every minute.
How do you determine the levels? Says Paul. I don't know how long you've got to go into that. That might be something that you need to refer to Alex's website for.
Yeah, I mean, in terms of how do you define levels, it's exactly what I said earlier. You're looking for reactions to levels. You want to see the market do something in a level. You know, looking at the weekly chart here, you know, if we were to identify the weekly levels, we want to see the market do something. So, for example, here, it came down to the level, it rejected it. Up here, it came up to this level and rejected it. You can see that that's happened, right? You can see that something's taken place. This down here, for example, where is my thing? That down here, I don't consider that a level. That's just the price moving sideways. Nothing's happened. You want to see the price move towards a particular level with momentum and then get rejected from that level. And then that becomes a support or a resistance level that you can trade from. If the market just moves sideways and it's kind of doing sod all, that's not a level there. People would put that in as a level, but it's not something that's going to be tradable because, to be frank, the market doesn't really care about what that is here. It cares about where there's a reaction. Does that help?
Fantastic. Interesting. Thanks, says Doug as well. So all round praise, Alex, for a great thing. EMA or SMA? Asking Andy. That's the moving averages, isn't it? Exponential or simple?
Yeah. I use the EMA, but it doesn't make that big a difference. There's no scientific reason for EMA. It's just I like to think that I've got a faster reaction.
Okay.
That's it.
Great. Paul says, yes, thank you. That makes sense. And Andy says, thanks. So Alex Ong from Traders Corner, I think we'll wrap it up there and say thank you. A collective thanks very much for a wonderful presentation. I think
thank you, Simon.
Got us all thinking about essential chart patterns that we need to be using. So thank you. And what we'll